January 30th, this number flashed across the market heat map, $118.43 million. Now, that's not just a number. It was the total value of high-risk, leveraged bets all piled up at a single price point. A massive concentration of capital that acted like a giant magnet for the price. Basically, it was the fuel for one of the most violent liquidation cascades of the year. We're about to show you exactly how this chain reaction was triggered. Drop a like and share if you find this valuable. Okay, first let's go over the setup. This is how the market got so unstable on January 30th, as all this leverage began to pile up in a very, very specific zone. All right, look at the screen. It's 4 a.m. UTC, and we can see these initial leverage pools starting to form. Notice those first bright bands of yellow and green showing up above the current price? Yeah, each one represents a big cluster of buy-side leverage, traders betting the price will go up. But really, it means they are incredibly vulnerable to a price drop. Just 4 hours later, at 8 a.m. UTC, that leverage intensifies dramatically. See how much brighter that central yellow band gets? The spring was coiling. More and more traders piled into leveraged long positions, creating that peak of $118 million in just one single band. This is a very precarious market structure. By 8 a.m. UTC on January 31st, the situation has become absolutely critical. The price, which you can see as the red candle chart, is now trading directly below these massive liquidation zones. I mean, the proximity is just dangerous. The target is painted. And to make sure you never miss these critical setups, go ahead and subscribe to the YouTube channel. And this brings us to the event itself. All that potential energy stored in that leverage is about to get released. And the result is, well, it's stunning. On the left, you've got the market at 8 a.m. UTC, just loaded with leverage. On the right, only 4 hours later, a complete erasure. Those massive leverage pools are just gone. So how did it happen? This was the cascade. As the price was pushed down to that first liquidation level, it triggered a massive wave of forced selling. That selling pushed the price down further, hitting the next level, which triggered more selling, and you get the idea. It's a domino effect, wiping out each pool of liquidity as the price crashes from around 84,000 all the way down to below 78,000 in a matter of hours. This brings us to the core thesis of this entire analysis. Price hunts liquidity. The market is brutally efficient at seeking out and neutralizing these large, vulnerable pockets of leveraged positions. It's a fundamental, unavoidable market dynamic. We post charts like this every day, so follow us on Twitter for more updates. After a violent move like that, the market doesn't just stop. It enters a new phase. So let's look at the aftermath and how new drops were immediately set. So after the cascade, the market found a temporary floor and started to consolidate. But look closely at the heat map from February 4th. These new, smaller yellow bands show traders building up leveraged positions all over again. The trap was being reset. And wouldn't you know it, the exact same market dynamic was about to play out again, just on a smaller scale. This just reinforces the core concept we're explaining today. The pattern is cyclical. If you're getting value from this forensic breakdown, drop a like and share. And here is the proof. On the left, you see the new liquidity pools that formed during that consolidation on February 4th. On the right, the aftermath on February 5th. You can see how those newly formed liquidity pools were targeted and completely wiped out in a secondary cascade. The pattern repeated itself flawlessly. This brings us to right now. Let's analyze the most current heat map. As of 20 UTC on February 5th, we can see newly established zones of high leverage. Look at these bright bands forming again. These now represent the next areas of risk and the next potential price targets for the market. So, what are the key takeaways from all this? First, massive leverage creates massive market instability. Second, price is inevitably drawn towards these large liquidity pools. Third, cascades are just violent chain reactions of forced selling. And finally, the most important takeaway, this pattern repeats because new leverage always builds back into the system. And that leaves us with a final provocative question. Looking at the current market structure, where are the new targets? If you want to track where those new targets are, make sure you subscribe and drop a like on this explainer. We post these analyses regularly. Follow us on X for real-time updates. We'll see you in the next one.